Welcome, everyone, to Name Confidential Live.
Welcome, everybody, to Name Confidential. This is season 2, episode number 28. I'm your host, Ben Fox, and I have Kean Amaral here with us today. Kean is a chartered financial analyst and the chief investment officer at his firm, United Success Wealth Management. So, Kean, welcome in here.
Thank you for having me, Ben. And I hope our viewers get some value from our conversation.
Oh, I'm sure they will. I've had a little bit of a teaser of it, so they will. We always start off with the name exposure index. I'm going to hop over here to the website. So as a reminder, the name exposure index represents the average equity exposure from our name members. And then, Keen, I think we had spoke about this a little bit earlier in the week that you're going to start to contribute to the name exposure index. Is that correct?
Yes, that is correct. This name and exposure index, I find it to be a valuable sentiment gauge. And while it reflects tactical equity exposure by active managers, I personally use it as a contrarian indicator at extremes. When exposure is high, markets are often overbought, in my opinion. And when low, it suggests an opportunity.
Definitely isn't the first, you aren't the first person to mention that as a contrarian indicator there. So, yeah, it looks like we saw a little bit of a decrease there from the previous week, 83.69 to 81.07. Um, not too much, not a lot of surprise there. Do you have any surprise about it just going down a little bit?
No, I won't be surprised by it going down a little bit because on many technical indicators, especially the RSI, the overall stock market, which is the S&P 500, is relatively overbought. So I wouldn't be surprised if this indicator goes down.
Yeah, we'll have to keep monitoring it in the next coming weeks because, August, September, as we get there, seasonality is going to kick in again. It's going to be interesting to see.
It's actually more than that. You see, next week we have, let's see what happens. We have a Federal Reserve meeting coming up because the last week of July, I believe they're going to be meeting next week. And then we have this tariff extension possibility on August 1st. So I think next week and the week after could see some increase in implied vol in the options market. So that's what I'm paying attention to. And I think we'll see that probably on Tuesday the tick up. So that's the most near term factors that I'm looking at.
Yeah, and I mean that's a good segue because I know you do a lot with options. So I'm gonna unshare my screen, let you share, and we can start jumping into your investment philosophy and market outlook.
Yeah, sure. Give me 1 second. Let me go ahead and share my screen and you let me know if you can see it.
Yes, I do.
Um, Very good. Before I get started, Ben, I just want to put three disclosures out there and just get them out of the way for me personally. One is whatever we discuss is for educational and entertainment purposes. Number two is, this presentation is not intended to be specific financial advice because I don't know who our audience is specifically going to be. And as always, past performance is not indicative of future results. Having said that, I can jump straight into
Hey,
our
Keaton,
invest.
are
Yes.
you able to go into make it a little bit larger? Because right now it's just looking at the presentation. I think if you go there from the beginning, up
Okay,
or
there you
down.
go. There you
Yeah,
go. From beginning. Oop. So let me jump to this slide.
did
Uh,
not, I don't see it.
Give me 1 second. I think I gotta go. Um,
Maybe
um,
try clicking on from current slide again. I might be able to.
yeah, I think that's what I should do. There you go.
Yeah, I'm not sure why it's not going full screen. Usually that does it.
Okay. Is it still not going full screen?
No, it's not. I mean, I can read it. It isn't going full screen, but we can make do with it.
Okay, which screen are you seeing?
The investment philosophy, pragmatic discipline time.
Oh, you are seeing the screen. Okay, okay. Um, Maybe I can reduce this column. Do you think it's better?
Oh yeah, that works.
Is this better? Okay, good. Excellent. Let me cross this out. Okay. So at a very high level, um, we believe the reason why one invests is to fight inflation and provide for our future self. So that's step number one. Um, when it comes to investment philosophy, it's a mix of execution, having investment principles, and that comes down to the following factors. One is the stock market in general is not always going up. We believe it moves in cycles. And we use the 200-day moving average of the S&P 500 as our line in the sand to determine if the market is moving up, the overall market that is, or if the overall market is moving down. And we believe that we need to have an upside strategy for when the market's moving up and a downside strategy for when the market is moving down. So that's part of our investment philosophy. Um, the other factors are we blend the exposure of the overall market index with a handful of businesses that we call the themes of the decade. So we believe every decade there are a handful of individual securities that are blessed with the wind beneath their wings and outperform other sectors during that decade. So we like to blend those two within our client portfolios. Um, the next is very, very key. It's easier said than done.
Hmm.
It involves investment discipline, and that is buy low and not or sell high. Um, that ties into the next part of our process, which is risk management and position sizing. And then finally, in almost all our client portfolios, we have this thing called an options overlay, where we try to enhance the yield of the return of our client accounts using options, and occasionally we use them for downside protection. And that basically summarizes our investment philosophy.
Okay. I do have a question. So in the upside and downside strategy, when you're using the 200-day moving average,
Yes.
so the second it crosses over and you see that switch, you go from the upside to the downside?
Fantastic question. So what we now let me zoom in on this chart. Let me know if you can see it. And now this is a
Yes.
summary of the S&P 500 from 2021. In August of 2021 is when the European Central Bank started raising interest rates before the Federal Reserve began. It was in early 2022 that the Federal Reserve began raising interest rates. So what we have noticed is we want to make that switch happen when the S&P starts trading below its 200-day moving average, but we give it 1 month because sometimes it uses that line as a support and bounces higher. So we look for this correction in time and then make that determination that the market is telling us that it wants to move lower going forward. And then what we observe happens, and this generally happens, is that it will then use the same line as resistance on the way down. But obviously, the downside strategy, well, not obviously, but our downside strategy is the most panic happens when we are very far away from this line. But even on the way down, there are places to lighten up as we approach the line. So we look at this line as an indicator for when the market is breathing in, move away from the line, breathing out, move into the line. That's on the way up and on the way down. So we tend not to want to chase the market because we know it's going to move in a wave-like fashion on the way up and on the way down.
Got it. Okay. No, that helps. Thank you.
Yes.
Trying to remember if I had another question about any of these other two then. Well, I guess what would you say is one of your biggest differences from your upside and your downside strategy?
Fantastic question. It all comes down to risk management. You see, at the end of the day, our mandate is to grow our client portfolios over time. And then there are times when we want to take more risk. That's when the market is in our favor. And there are times when we need to take less risk or capital preservation. So the downside strategy is about capital preservation and trying to grow the portfolio, understanding that we're in a downtrend until that changes, to keep an open mind and understand that these trends can change at any time and be prepared for both scenarios. But these are strategic and not tactical moves within the market. And within that long-term cycle, we have a way to play it tactically as well. Does that answer your question?
Yeah,
So,
yeah, no, I think so.
okay. So very simply put, downside, right? Lower equity exposure, more defensive. Upside, more offensive, higher equity exposure.
No, okay. Yep, no, makes sense.
Excellent.
Shoot, I had a question. Just it keeps escaping my mind. It was along the lines of what we were just talking about too. Um, oh, so the strategies, I think I remember in some of the other material that you provided before, it's not just you specialize this strategy to each client that you have. So it's a similar strategy, but it's going to be specialized for each of those clients. Is that correct?
Oh, fantastic question. The answer is yes. So what we do as a firm is we run customized portfolio for every client. And we have been able to create this through our internal softwares. And we have clients who have multiple accounts, but no two accounts have the exact same positioning. So that's step number one. Step number two, and that revolves around our investment execution and investment process. Okay. And why is that the case? The case for that is because not all clients have started at the same point in time, and every point in time, the market dynamics are changing, and clients take out and put in money at different points in time. So that has to be taken into account because the same stock is not at the same price when that new money comes in or goes out. Fair enough?
Yes.
The second very important component of this is every private client has a personal risk tolerance and has a time horizon as to when sometimes they might need a certain part of their funds. So hence, we end up creating a customized portfolio approach. But overall, the client is turning over the responsibility as to know how to grow their accounts, given their constraints in our hands. Does that make sense?
Yes. I guess I'm curious from a client's perspective, what have you seen with that very specialized approach? Because a lot of advisors will have kind of these different buckets, conservative, moderate, aggressive, and then, maybe moderately aggressive in there, and they'll use it as a basis point. It might get a little bit more specialized in there, but sometimes as a client, you may just feel like you're put into one of those buckets per se. So what have you received any feedback on like I really like how specialized this approach is? It feels like it's made just for me.
Um, when it comes to specifically on the client side, so what I'm sharing with you is the firm's investment philosophy, principles, process, and execution, and on how we approach the markets.
Okay.
Whether the client is conservative or aggressive, it does not matter. This is purely from the point of approaching the markets. The question you're asking is very specific to from the client's perspective. To end up at the portfolio that the client has, we have to take the client's personal preferences into consideration. And that is where the clients get customized portfolios. In fact, I'll take it one step further. It's not only just being conservative or aggressive, right? Some clients have a preference as to certain businesses that they might not want to see in their portfolio. So, for example, a controversial stock that came up last year during elections was Tesla. Even if we find opportunity in that particular business at a lower price based on a forward return in that business, we could have a client that says, hey, listen, we don't want to hold that stock. So we respect the client's preference. That's how the client gets a customized portfolio. So there's a lot more than just conservative or aggressive. You see what I'm saying?
Yeah, no, that clears it up.
Excellent.
Well, perfect. I think we can go on to the next slide. I can't remember if the next slide is market outlook or more on investing.
No, let's go to the next slide. So the next slide, I think, yeah. So this slide is about our key market thinking as of now. This is July 2025. So what we have behind us is the S&P staging one of the fastest rebounds, I believe, in recorded history, from I think about a 15% decline at intraday decline at some point in April. We have this new thing called this U.S. tariffs, which were at the beginning of this year 2.5%, now at 15%. And we got this big fight brewing. It's almost like a title match. But we've seen this fight before. It happened in 2018, I believe, between the same participants, President Trump on one side and Jerome Powell on the other side. It was a title fight. And the markets did react because there was uncertainty around it, and the markets moved down. I don't know if you remember, in December of 2018.
Oh, yeah.
So we are seeing part two of the same fight. Now let's see how this pans out. But that's something else that we're watching. What's also interesting is we follow this crowd sentiment index, because we generally have observed exuberance and the mind getting more complacent, the retail investor mind getting more complacent and wanting to chase higher returns at higher prices based on hindsight. So we're seeing a very big increase in optimism today from a record low pessimism in April. So that's interesting. As of today, listen, the S&P 500 is trading above its 200-day moving average. There's a saying, I think it was Maynard Keynes who said it, The Economist, is the markets can stay irrational longer than you can stay solvent. So as long as the S&P 500 trades above its 200-day moving average, we don't know how long and how high it can go. So we are relatively constructive on the overall US equity markets. Okay. And then, of course, we use options because that helps us not have to buy at the market, and risk management and things like that. So that's kind of our current market thinking. If I can spend a minute, I'll share with you our outlook, but go ahead.
Well, I was just going to say, do you have any thoughts on, in more recent years, think 2020, or even this year, we're seeing a little bit more of these V-shaped, faster recoveries. Do you think that's something that we're going to continue to see just with the speed of information and how it flows, or is that just something that's a little bit more unique to the time that we're in and the things that are going on?
Fantastic question. And I addressed this with clients in April. You see, the stock market, we have to keep in mind and understand, can go down in two ways. It doesn't have to go down in one way. It goes down in two ways. One is called a strategic downturn. So strategic downturn starts slow and then starts getting bigger and bigger on the way down. Okay, that's what we saw in 2022. This is when we have what's called persisting uncertainty. In 2022, the persisting uncertainty was for how long and how high the Federal Reserve was going to raise interest rates. So in the face of extended uncertainty, it keeps going lower. The stock market can move down in the second way. The second way is called a crash. So when you to understand a stock market crash, you've got to just look at the chart. When you see the line dropping very vertical, right? That is a stock market crash. It happened in 1987. It happened during COVID in March of 2020. It happened in front of us now in April of 2025. These are three examples that come to mind as we speak. Yeah. 2022 and 2008, the financial crisis, was a strategic downturn. So you have to understand how the market is moving down and then classify it in one of these two buckets. Step number one. What the next downturn is, I don't know, but when I see how it unfolds, I will know. Fair enough? Number two is the biggest risk in a vertical crash is a V-shaped recovery. The biggest risk on the table in a vertical crash is a V-shaped recovery. And I say that for two reasons. Number one, you look at March of 2020 in COVID, there was a V-shaped recovery because of an overreaction by the Federal Reserve, obviously, and the Treasury sending out free paychecks. But now you go back and look at the 1987 crash. The Dow dropped, I believe, 37 to 38% year to date from January to October of 1987. And the stock market closed out the year within 2 months. October, you had November, December, 2 months, a little over 2 months. Closed out the year plus 2% on December 31st, 1987. The biggest risk on the table in a V-shaped pullback or a drop is a V-shaped recovery. So, in a vertical drop is a V-shaped recovery. Okay.
Yeah, no, that's interesting. It makes a lot of sense when you put it out there, and yeah, you just put that into. I like that a lot. You put that into perspective for me. These different kind of bears that we've seen over here
But
recently.
all of what I'm explaining to you is actually captured in our models, and our models tell us exactly what is happening and what to do, which puts less pressure on opinion and makes our process much easier because it's more mechanical, and we love it.
Yeah, no, and we're big on that at Scarecrow is just having something that's 100% mechanical. I think you had mentioned before we got on the call, you haven't watched the news since like what, 2018 or something like that, 2017.
Yeah. In that
And
time frame, I stopped watching the news. Correct. Sorry, go ahead.
yeah, and it's just the second you let emotions in, your strategy can just go haywire, and it's not consistent anymore because emotions go all over the place.
True.
We can hop back into this.
What's that?
I said we can go back into this. That was all my questions.
Well, you know what? Outside this market outlook, which you can read for yourself, there are three wild cards I would like to share with you, which is I would say a little concerning, or something that we have on our windscreen, so as to say, when we're driving this car of investing. We're paying attention to a lot of factors and variables, but these three wild cards are something I just like to highlight. One is the potential for geopolitical escalation. Okay, that's wildcard number one. Wildcard number two is an AI-driven unemployment spike that the Federal Reserve could potentially react very slowly to. That's wildcard number two. We're actually seeing this happening on two fronts. One is we're monitoring the white-collar worker unemployment. The second thing that we're monitoring is, and there is plenty of coverage on this particular topic, on recent college grads not getting jobs. Okay, so that's the second wild card. The third wild card is this debt explosion. I won't say so much the dollar weakness, because I looked at the dollar chart. We're still relatively strong, at least on the Dixie, compared to 10 years ago. We were significantly appreciated as a currency. So I would say more debt and hyperinflation would be my wildcard number three. So I don't know how it would be handled, but we don't have some good precedents for how hyperinflation is how it typically resolves itself outside a currency reset. So these are the three wildcards on the table. And they are only wild cards until they get wild. Until then, they remain cards.
Oh yeah, I have a feeling that AI-driven unemployment's gonna sneak up on us faster than we might think. I think while looking at the time here, we are coming up on our time. Let's cover the your favorite investment quote, because that's always a fun one.
Yes. So I tried very hard to come up with one investment quote, which was very difficult. So I'll tell you that they tie into each other, but these are the investment quotes that have had a bearing on shaping my thinking. One is first two are from Jesse Livermore. You know, so he said that the stock market has been around for 100 years. It's going to be around for the next 100 years, and everything that's happening in the stock market today will happen in the future. So just understand there's always a different story, and we always say that this time it's different, but it's really not. So that's number one. And number two, this ties in with what Mark Twain is often quoted saying, and I don't think Mark Twain had anything to do with investing, but it's an investment related quote. And that this history never repeats itself, but it often rhymes. Um, uh, and the reason this resonates with me is because I see this happening over and over, which allows me as a portfolio manager to do my decision making. And so those are my favorite quotes, so as to speak.
I mean, that's what we're doing. We're mechanically finding ways to put a value to the greed and fear that makes its way into the market. We're driving
Yeah.
it. As humans are driving it right now. So,
Yes.
yeah, no, those are really good. I don't know if Mark knew that he was gonna impact the stock market with that quote back, because I hear that a lot in the industry.
Yes. In fact, they quoted this in the beginning of that movie, The Big Short. And I never knew about this quote until I saw that movie when it came out about the financial crisis. But this quote has stuck with me now for a decade.
That's awesome. Well, I do got to put a plug in here. We got NAAIM Outlook coming up here in November. So it's November 3rd and 4th in Chicago. Kean, are you planning on going? You going to try to make it?
I'm going to definitely try to make it. We're very excited. We're opening our new office, our first office, hopefully next month, fingers crossed. So that's taking a lot of our focus. But definitely going to try to um, make it for the NAIM conference. Yes.
Well, perfect. Well, if you sign up, I think it's before August 1st, as a member, you can get the price of $589. If you don't sign up, then it does bump up to $680, and then for non-members, it's at $878. So if you want to save some money, get in there in the next week. You got about a week to do it. We got a
Yes,
lot of
Ben.
speakers. I think we have a lot of gyms and mats, is what I've heard. So I'll have to look at the list, but we'll have some more information on that. And Keen, I want to thank you once again for coming on here. If you want to put I think you have your bio next. You can put that up here
Oh,
quick.
yeah.
People can
Yes.
read a little bit more on that.
There you go.
But yeah, if you're ever interested in a conversation, do you have your email on there? Yeah,
Yes,
you
it's
got your
right
email
down here.
on there, and reason to always join NAIM. Some of these speakers, if you ever want to talk to them in person and go to some of the conferences, Kean will be there. He's going to show up in October. He doesn't, or November, sorry. He doesn't know yet, but you're going to be there. So,
Definitely.
well, perfect. Well, thank you so much, Kean. I hope you have a great week, and we'll catch everybody at the next episode of NAIM Confidential.